First of all, it is my true honor to be a moderator of this session on the U.S. trade policy and restructuring of the global supply chain. And we have truly distinguished speakers in our session, probably the best people in the world who can discuss this matter. So let me briefly introduce the speakers in the order of their opening remarks of this session. So first, Ms. Wendy Cutler, Vice President of the Asia Society Policy Institute. Prior to having this position, she has been a diplomat and a negotiator in the office of USTR for more than 30 years. And she, in fact, also involved in negotiating the U.S.-Korea Free Trade Agreement. Second, Professor Pinelopi Goldberg of Yale University. She is a world-renowned scholar in the field of international trade and development. She has also served as the Chief Economist of the World Bank. More recently, she has started to conduct serious research on how the change in the U.S. policy affect the world trade, such as the U.S.-China trade war started in 2018. Third speaker is Dr. William Lee, Chief Economist and Executive Director of Milken Institute. Before joining the Milken Institute, Dr. Lee was the Managing Director and Head of North America Economics for Citigroup. And before that, the Deputy Division Chief of IMF. So he has a great expertise in international finance and commercial activities, both from the public policy point of view as well as business. So let's start our session with Wendy's opening remark on U.S. trade policy.
Well, thank you very much. It's really my honor to be here this morning. There's so much we can talk about. And when I think about how we got to where we were on trade, and I look back on my career, I feel that the 30 years or so I was at the office of the U.S. Trade Representative, I really worked on opening markets, but also promoting fair trade. And so over time, the opening markets part got harder and harder as the American public became more and more skeptical with trade. And so as a result, at USTR, we tried very hard to make our trade agreements more fair and more beneficial to the average U.S. American and the U.S. worker. Clearly, we did not go far enough. And I think the discontent with these trade agreements and a feeling that the United States was getting the short end of the stick really laid the groundwork for the emergence of Donald Trump during Trump 1.0. Trump, for many, many years, was very focused on trade. And frankly, as a real estate developer in New York, he was very focused on Japan, frankly, in the 80s. And over time, that kind of shifted to China. But in any event, during the campaign, as a result of his position, both Hillary Clinton and Bernie Sanders also came in very strongly against trade. And during Trump 1.0, as mentioned, he made a lot of, he was able to really influence U.S. trade policy. But he focused more on China, frankly, and he also imposed tariffs on steel and aluminum, and also, however, negotiated the U.S.-Mexico-Canada agreement, our largest free trade agreement. This time around, I think there are some real differences between Trump 2.0 and 1.0. Number one, he's just hit the ground running, right? The first term, he kind of took his time, and a lot of his advisors were arguing about, the best policy going forward. But this time around, he really knew what he wanted to accomplish, frankly, and I think he's done it with warp speed. And I think to the surprise of many, we're only 7 months into his administration. For many in the United States, it feels like years at this point. But he has really, let's just say, wreaked havoc on the global trading system as we know it. And this time around, he really hasn't focus exclusively on China. In fact, all of our trading partners, including our allies and partners, have experienced high tariffs, and many have negotiated trade agreements. What I wanted also just to stress is that in the mind of Trump, he's remaking the world economic order from one that was based on kind of the U.S. being the leader and working with others to open markets and set global standards and norms. And we're moving away from that. The United States has made it clear we don't want to be the leader anymore. We want to do what's right for us. And if that means upsetting other countries, so be it. Because the feeling is that the current trading system benefited everyone else and not the United States. And frankly, the U.S. Trade Representative, Jameson Greer, if you haven't read it, wrote a piece in the New York Times a couple of months ago titled, We've remade the global world order. And in that piece, he makes the argument for why the current global order is not in the U.S. interest. And I think he makes some excellent points. Where I disagree with him is that I don't see the Trump administration rebuilding a new global order. And he argues that we have, and it's one really based on U.S. interest, from the U.S. perspective and what works for the United States. And I think now as we look forward into what the global order could look like, there are many competing views on this. While some of our trading partners are also not completely happy with the global trading system, I don't see them walking away from the system as the United States has. In fact, we are seeing many countries out there negotiating between themselves either new free trade agreements, updating free trade agreements, working on sectoral agreements, working on economic security agreements. And I think we're going to see more and more of that going forward. And unfortunately, if the United States is not part of that, we will be excluded, and the benefits, we won't be able to derive the benefits from that system. So maybe with that, I'll stop and turn to others then.
Okay. Now, thanks for your sharing your perspective on where we are in terms of U.S. trade policy and potentially where we will head in the future. So now, the next we'll hear the view from Penny Goldberg about the U.S. trade policy and how that may actually have changed, like a global supply chain, I guess.
Thank you very much for the opportunity to speak today here. The topic of our session is hotly debated across the world, and one can talk about it forever, so I will try to keep my remarks brief. I will focus mostly on what we expect the effects to be on other countries, smaller countries like Korea, and then I hope we'll have room to take questions and have a discussion. So first, let me follow up on some of the comments that Wendy made to stress how this round of trade tensions is very different from the previous one. So Trump 2.0 is very different from Trump 1.0. In the previous round, as it turned out, many countries fared well in the aftermath of the trade war. So despite the fact that tariffs were imposed, and these tariffs in the US were high relative to what had been practiced in the past, research showed that actually many countries benefited from these tariffs in terms of their exports. And actually Korea was one of the countries that benefited. And I should stress in terms of export performance. This is one metric. This is not a statement about general well-being, economic well-being or welfare. Why did they fare well? Because global supply chains adjusted very quickly. Many countries managed to adjust their operations so that they could bypass China, go through other countries. What we found in our research is that their exports increased not only to the US, but also to the rest of the world. And this speaks to the adaptability of the world trade system. I should also emphasize that all these countries were countries that were already integrated in the global supply chain system. So when this round of tariffs announced, one possible reaction was it was going to be like last time, and countries would manage to navigate this new environment, which represents a very stark departure to what we had in the past. So I would like to argue that this is unlikely for a number of reasons. And Wendy already pointed out some important differences. I would like to stress some of them once more and add some other ones. The first is that these tariffs are substantially larger, or at least the tariffs that were announced are substantially larger than the tariffs of the previous round. So in the previous round, we talked about tariffs of the order of 15 to 20%. In this round, we talked about tariffs of 60%. Second, the first round of tariffs targeted China alone. This round of tariffs targeted every country in the world, including very close US allies like Canada or Korea, including Mexico, including countries with which the United States has very close relationships. And in fact, as it turns out, if you were very closely aligned to the US, you were hit harder than countries that had more distance to the US. Third, if you study the US trade policy, the current US trade policy, it's very hard to figure out what the objectives are. The current administration has never articulated a clear vision of what they are trying to achieve. And one may agree or disagree with the goals, but one needs to know first what these goals are. And so, for instance, some of the goals that have been suggested are reshoring manufacturing to the US, so bringing industry back to the US. Another one is raising revenue at a time when the trade deficit and also the budget deficit in the US are very high. Try to increase revenue from tariffs. A third one is eliminating the trade deficit. And finally, another one is disciplining other countries. So we saw that, for example, in the case of Brazil or in the case of India, when the US government is trying to achieve a particular objective. And the problem with this is that some of these objectives tend to be in conflict with each other. So at the same time, the US is trying to keep prices relatively low in order not to hurt US consumers. And if you think about it, it's impossible to achieve reshoring of manufacturing, to bring manufacturing back to the US if the prices don't rise. The reason US consumers would switch from foreign goods to US goods are because presumably the foreign goods are more expensive, and they would be more expensive because of the tariffs. So you cannot achieve all at once. And it's this inconsistency that makes it very hard to figure out how to respond to these tariffs, what the objective is, and what the best adjustment strategy is. And finally, last but not least, another feature of this round of trade policy is that the tariffs that have been announced on April 2nd, on Liberation Day, were not the final tariffs. So many parts of the Trump administration made it very clear that this is just the start in the negotiation process. And in fact, we've seen constant negotiation, bilateral agreements. And as a result, these tariffs often were not implemented, or the actual tariffs that now countries have agreed on are substantially lower. So on one hand, one may say this is a good development because the initial tariffs were not implemented. On the other hand, it makes very clear that we're in a constant negotiation, that you cannot take anything as given, that everything is going to be renegotiated. And this speaks to a general change we see in recent US trade policy. We have transitioned from a rules-based system to a power-based system. And so the US is currently exercising its power. That leaves smaller countries at the mercy of the US interests. All this would be fine if we had, again, a very clear view of what the US interests are, because then smaller countries could find a way to adjust. But the problem is we don't even have at this point a clearly articulated vision of what the US is trying to achieve. So My point here is that all this makes it very clear for countries to figure out what the best response is, what the best adjustment is, both at the country level and also at the private sector level, at the industry level. And so that's another layer of uncertainty because we don't even know what the proper response is going to be. So as a result, most countries have been doing, including Korea, is trying to be pragmatic, play it by ear, avoid escalation, try to go along with the US. And that seems a very reasonable response in the short run. It doesn't tell us much about what is going to happen in the long run. In my opinion, the rational strategy in the long run is to try to gradually decouple from the US, reduce dependency. As I said earlier, one lesson from what was announced on April 2nd was if you were very closely tied to the US, you are actually hit harder. From the US point of view, and I'm a US citizen, this is a huge loss. It's not clear why the country wants to do that. Right now, the US has enormous power and enormous leverage precisely because it was engaged with other countries so closely in the past. By cutting ties, you may put America first, but at the same time, you are reducing your power in the long run and your leverage in the long run. So it's not clear why this is a good strategy for the US. For this reason, it's also not clear that this strategy is going to stay in place forever. It could be that this strategy is going to change when the president changes. But once again, my conclusion is, and I will stop here, that we live at a time of extreme uncertainty, what many call Knightian uncertainty, in the sense that we have no idea what is likely to happen in the next few years. And that makes the effects of these changes hard to predict, but it's very hard to be optimistic about the future. So I will stop here.
Thanks, Penny. I really appreciate your view that it's really hard to rationalize a current U.S. trade policy, and a lot of uncertainties really makes a lot of countries, private, like government and the private sectors, to be having a very hard time. And she also suggested a country like a small open economy like Korea might want to, if this kinds of uncertainty continues, might want to engage less with the U.S. economy to reduce these uncertainties, and then might happen. But anyway, so we will actually continue for our third speaker. Bill, can you share your views about this issue?
Yeah. Thank you very much, Jay. I'd like to give a slightly different perspective on what you just heard. What you just heard was actually a fantastic and classic rendition of why every economist you talk to practically will say, tariffs are terrible. They distort production. They raise prices for consumers. They tax consumers. They shut down the gains from trade across borders, right? And so you got to ask, why did President Trump get elected on a tariff policy? If he's going to put all these tariffs in place and do all these terrible things, why was he elected? Well, he wasn't elected for tariff policy. He was elected because he promised to make America great. And how is he going to do that? He's going to shrink the size of government to free up resources for the private sector. He's going to lower taxes, and he's going to put away and get rid of a lot of regulations. And he's asked the world in his very first speech at Davos, U.S. is open for business. Come invest, bring your capital to the United States, invest here, create jobs here. I'll give you more resources with smaller government, lower taxes, fewer regulation. And if you partner with us and produce here, I'm going to protect you from unfair competition from the rest of the world by putting a tariff barrier around you. That's where tariffs came in. It was a sideshow to the investment program that he promised Americans. And he promised the world, come partner with us, and you have the benefits of all these things and protection with tariffs. But if you choose to compete with us, and in order to gain entry to our marketplace, you're going to have to pay a price of admission. And that price of admission would be the tariff. And I'm going to charge each of you differently depending upon how you open up your markets to us. That, I think, is the context of the tariff policy. So you're right. I used to teach international economics, not as well as Penny, but when I was at Columbia, the first thing you talk about tariffs is it's a terrible thing. And so when doctors, a metaphor would be doctors examine you and find that you have atrial fibrillation, irregular heartbeat. You know what medicine is prescribed to you? Coumadin. You know what Coumadin is? It's called rat poison, right? It thins the blood and kills you if you have too much of it. Tariffs are like Coumadin, right? They could kill you, but in the right hands and the right amount and with an overall package of therapy, it can make you better off. So that's the perspective. And so what about the reduction in gain in the trade that occurs between countries? Well, one of the theorems of international trade that the Nobel laureate Bob Mundell wrote about in 1957 was, when you shut down trade, you can get some of the gains from trade back by allowing factors of production, capital, technology, and labor to go across borders. So some of the offset to the loss of welfare is by factor mobility. And so that's exactly what President Trump said. Come invest in the U.S. Come invest in the U.S., bring your capital here, bring your technology here, partner with us, employ our labor, and you will benefit from the kind of gains from trade you would have if you produced at home. All right, so that was the deal that he offered every country. Now, Wendy's very right to say that this time things were different because he came in so fast, and to some of our closest trading partners, he said, 40% tariff, 50% tariff. Well, again, they were intention behind the tariffs on Mexico and Canada. He said, there's so much poison coming across our borders. You got to help shut us down. And if you don't help us shut it down, I'm going to charge you. So that was the purpose of those specific tariffs, was to shut off the fentanyl trade, right? It was meant for a non-economic purpose. And if you're going to criticize President Trump, where I would criticize him would be, he loves tariffs so much. He uses this one instrument to do everything. And another theorem in economics is, if you have a lot of targets, like you have three targets you want to hit, you need three separate instruments to hit it. You can't use one instrument to hit three targets. He's trying to hit 1,000 targets, and he's using this tariff instrument to try to do anything. So that causes a tremendous amount of uncertainty, that causes a tremendous amount of frustration because you can't hit all those targets with the one tool. But he's not using just one tool, remember. Smaller government, lower taxes, fewer regulation. Those were the big tools that he put in place. Tariffs were just one of the other instruments that he was using. But it's gotten a lot of press. And I think it's caused people to be very anxious that this one tool is being focused on as opposed to investment that's going on in the United States. And if you look at the GDP numbers in the United States, GDP in investment has been rising by double digits in the first quarter. When these policies were being talked about and just about put in place. So investment really is going up. Now here in Korea, you got to ask yourself, why is the United States, a capital-rich country, sucking up all the capital in the world? Shouldn't it go to countries where there's less capital? Like the poor countries in Africa, right? The poor countries in South America, the middle-class countries. That's where capital will do most good. Well, another Nobel laureate, Robert Lucas, looked at the data about capital flows around the world. You know what he found? On net, capital flowed from capital poor countries into capital rich countries. And why is that, right? It's a paradox. It's called the Lucas paradox. Well, the reason for that was because capital goes to where the rates of return are the highest. Now you think that, well, if you have very little capital, a little bit of capital put in, wow, you're gonna make a lot of money. But the other thing that influences rates of return is innovation. Where's the source of most innovation and the highest return to capital invested? United States, right? Artificial intelligence, Silicon Valley, all the high-tech industries, right? A lot of the innovations are there. So if you want to allocate capital to its most efficient use and benefit from the high returns that come from it so that you could benefit from that invested capital, the United States makes sense to invest capital. So I think these are some of the things that I think put perspective on a lot of the uncertainty that's been talked about and say, gee, why is he doing all this stuff? This, I believe, explains some of it. Now, I promised, Jay, that I would say some bad things, right? I already said a bad thing was using tariffs to do too many things. If you induce a lot of capital flow out of countries, that huge amount of flow out causes the disruption possibly in the country's financial system. It can dry up liquidity, for example, cause banks to have short on money in order to lend to local businesses. So a lot of the recommendations of regulatory authorities around the world has been put on capital controls, limit the amount of capital going out of countries. I think that's a really stupid thing to do because, again, you're asking yourself, are my fears of financial instability so great that I would deprive the country of the high rates of return? That's a case-by-case choice. There's no one answer fits all. But I think there is a danger of capital flooding out, capital flooding into countries. They might overwhelm the banking system and financial system of those countries. That is a terrible thing. But you fix it not by putting on capital controls, you fix it by making those institutions stronger. More capital requirements, right? Better governance, right? Better lending procedures. That's how you make a system safe. You don't make a system safe by, oh, no. You can't let the capital come in, you can't let the capital come out. So those are some, I think, intuitive answers to some of the points that were made here, which is say, what the hell is going on? I think this is what's going on.
Well, this is great because we are having some competing views about what's going on. So let's actually talk about like maybe the comparing the view between maybe the penny and the bill. So Penny, can you say something about what Bill said about the Trump trade policy, maybe doing something really good, at least good for the U.S.?
So first, let me point out that we agree on some points. For example, on the point that the Trump administration is using tariff to achieve every goal, and that was part of my comments, that they're pursuing multiple goals just with tariffs, and that doesn't seem sensible. I also completely agree that investment goes to the countries where there is promise of a high rate of return and where there is innovation. But I think that's where our agreement stops. And the last stance raises the question, why then the Trump administration needs tariffs to bring capital to the US? The US is a very attractive destination, has been a very attractive destination for capital for many years, precisely because it's the land of innovation, precisely because investors could be absolutely sure that they will achieve high rates of returns and their investments were safe. We didn't need the tariffs in order to achieve that. On the other hand, investment loves certainty, especially investment that takes a very long time to complete, where it involves very high sunk costs, very high fixed costs. There is a lot of research that shows that. In the current environment, it's very questionable to me whether companies will want to invest in the US. Perhaps they want to do it in the short run, they want to agree to it, again, to appease, but this is a policy of appeasement. This is not an investment policy. And last but not least, Bill talked about factor mobility. So there are two factors of production. In the textbook analysis, there is capital and there is labor. Now, in the US, we've had full employment for the last few years. Employment, creating jobs in the US has never been the issue. Creating good jobs is a different story. And many companies that try to invest in the US are confronted with a reality that often in the US, you don't find the skills that they demand. The investment of TSMC in Arizona is a classic example of that, where they often have to bring engineers and other professionals from Taiwan because they couldn't find local talent in the US. So what the US really needed was all these, it needs its labor to be upgraded. And it's not clear that tariffs are going to do that, or that it's the right step towards this strategy. At the same time, I'm not sure if that's the right time to bring this up, but I'm sure it's on everyone's mind. You see at what happened in the Georgia plant of Hyundai in the last few days. This does not induce other countries to invest in the US. And last but not least, even if you take the view, as Bill does, that for specific companies this can be good news. Let's say TSMC invests in the US. it may still maintain its top position in the semiconductor sector, and other companies may follow suit and they may do well. Well, it may be very good for TSMC. It's not clear this is good for Taiwan. And that applies also to other companies. The companies may do well. It's not clear that the countries that where these companies used to be based on are going to do well. And again, you may take the view that from a US point of view, this is irrelevant because every country is trying to maximize the welfare of its own citizens. So from that point of view, it makes a lot of sense that President Trump is trying to make America great again and does not worry about what happens in Korea or Taiwan. And there I would counter that despite what is currently said in the media, the US has benefited tremendously since World War II through the way it engaged with its allies and through its partners. This favorite say of economists, trade, and I would say economic welfare are not zero-sum games. Everyone benefited. Applied in the past, it applied to many parts of the world, not everywhere, but certainly to Asia and certainly to the United States. And this strategy of bringing down the current system, Wendy mentioned some of the reasons for that. Not everyone benefited, but I would claim that the people who lost tended to be within countries, not across countries. So not everyone benefited, but bringing down the whole system is not the right solution, not even from the point of view of the US.
If I can just add one point too, is that these tariffs are hurting folks producing in the United States. And just take the auto sector, for example. Our auto companies now are complaining that by lowering the auto tariff for the EU, Japan, and Korea to 15%, that those countries have an advantage because they don't have to pay the steel and aluminum tariff where GM and Ford and other subsidiaries of foreign companies in the US have to pay those tariffs. So the price of inputs is getting much more expensive in the United States, and I think that is going to contribute to making it more difficult to attract investment. I agree with Penny, adding on some of our immigration policies. We're seeing this play out where Trump has kind of conflicting priorities here. One is to attract foreign direct investment. The other is to enforce our immigration laws. And, the two of them, as we've seen this play out, are creating a lot of difficulties for foreign investors. I would also add that in these trade framework agreements, we are also pressing countries to set up what are called investment funds. And just last week, Japan and the US concluded a memorandum of understanding on a $550 billion investment fund. And when you look at what was agreed upon, although Japan and the US, there's a committee where they'll look at projects jointly to recommend, at the end of the day, it's really a US decision. If the US doesn't like the fact that Japan has rejected some kind of investment, then the US retains its right to reimpose the tariffs. And my understanding is that with Korea, we're going to be seeking, there has been agreement in principle on a $350 billion investment fund with the details to be worked on in the coming weeks.
Okay, Bill, can you respond a little bit? Yeah.
These are all very valid points. And in fact, I wouldn't disagree with any of them, except, again, the perspective, right? In the short-term perspective, you're absolutely right. It's very hard to get enough investment to pay off to compensate for some of the losses of putting in these sudden policies and inducing so much volatility in the financial markets. But what you got to ask yourself is, right, what time frame are you worried about? If you're worried about investments over the next 6 months, yeah, you're getting killed unless you have invested in NVIDIA or TSMC and the countries and companies that have benefited from these immediate deals. But if you have a longer term perspective and you have a perspective on what is good for the global economy, what is good for the national economies, right? Then I think you have to admit that a better reallocation of resources like capital a better realignment of supply chains, because don't forget, COVID taught us how vulnerable we are to one set of supply chains for everything, right? Having multiple supply chains, safety, soundness, and security are objectives that are very, very important. And you can only have that with multiple supply chains. The new world order that is being put in place is, in fact, a lot of bilateral deals, a lot of regional deals, a lot of sectoral deals, a lot of company-specific deals. A very messy set of rules, right? You say there's no more rules-based system. Well, there are different rules. And they're much more of a individually negotiated set of deals. It will be very messy. And you have instances where TSMC brings in engineers and they're fine. Hyundai brings in foreign workers to work on their Georgia plant, and suddenly they're rounded up and kicked out because, again, one company did the due diligence and their lawyers said, oh, you need this kind of visa in order to work here. The other company didn't. Again, it has to do with the amount of due diligence you put in place, the amount of work that you have to do to make these investments work. It's going to take some time, yes. It'll be costly in the interim, yes. But overall, are we going to be better off with a safer, more robust world trading system where you have multiple supply chains? Are you going to be more secure in Korea knowing you've got a partner with the U.S. where you have low tariff rates and you have strategic alliances where the U.S. can make use of your shipbuilding, the U.S. can make use of the things that you are skilled at to replicate a lot of the things that TSMC can do because we want multiple supply chains. Again, these are aspirations, right? These are blah, 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 pie in the sky stuff. But that's what politicians are all about, right? They get elected on promises and they are kept in place if they put the policies that work. If after 3 years, all these policies start falling apart and nobody gains from trade, you can bet your bottom dollar that he'll be elected out of office or his party will be elected out of office and you get some other alternatives put in place. Think about the kind of world that will come back, the kind of world where you have supply chain vulnerabilities, the kind of world where you have a lot of uncertainty about whether or not you're going to be a friend of China or not. That's a different kind of uncertainty, a different kind of Knightian uncertainty. You know, another fancy way of saying Knightian uncertainty, but you know, it's what one of our defense secretaries said. It's the unknown unknowns. You don't know what the hell they are. You can't plan for them, right? All you can do is try to manage as best you can. And so right now, all I'm saying is we're managing the best we can.
Okay. Well, thanks for your response. Well, as a Korean, as a moderator, like we all know that like stable global economic order really help Korean economy to grow, prosperous, and so on. Now, I think what's happening is scary from the Korean point of view. And I would like to kind of raise discussion whether this mess or like this big uncertainty is going to be the new order, at least of the US, or maybe in the future with the involvement of the legal system in the US. For example, the Trump tariff is now being kind of challenged by the US like appeals court and is going to be going through the Supreme Court. And also like more broadly, like US has this political system. In fact, as far as I know, US Congress has the authority over deciding the US tariff policy. So maybe the political process of US may actually readjust. It might be what's happening might be just go away, or it may not go away. And also another issue is how the world react to this new US trade policies and so on. So I think I'd like to hear your views about this, and why don't we start with Wendy?
Okay, so first Congress, okay? Now I'll just say I'm shocked that our Congress is so quiet now about U.S. trade policy. I worked at USTR for many, many years, and probably one of the most, let's just say, okay, I'll just be really frank, one of the most difficult parts of my job was briefing Congress, right? Because they had the authority over trade. They would bring us up to Capitol Hill and say, why aren't you doing this? Get us that. And until you do, don't come back, blah, 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 blah. Now Congress is completely quiet as the president is using trade authorities in ways that I would argue that Congress probably never contemplated, particularly the use of the International Economic Emergency Powers Act, the IEPA. And he's using that authority in order to justify the reciprocal tariffs. The Supreme Court yesterday decided that it is going to listen to that case on an expedited basis. Briefs will be submitted shortly, and there will be, a hearing as early, I think, in November or October, November, and maybe a decision in the Supreme Court by early next year. But what I warn all of our trading partners is that don't wait for the Supreme Court to act against IEPA. And even if they come out against the president's use of this statute, that does not mean the tariffs are going to go away. The president has other tools, other authorities that have been delegated to the president by Congress. And he'll use those authorities in the event that IEPA is not viewed as constitutional. And those include a statute he's already using aggressively, Section 232, the national security statute that allows the president to restrict imports in the case of U.S. national security being threatened. He has Section 301 that allows him to go after unfair trading practices in third countries. There's Section 122 of the 1974 Trade Act, which allows him, for balance of payments purposes, to increase tariffs to 15% for, I think, 270 days. And there's also another provision that all the lawyers are trying to figure out, Section 338, which was never used before. And so, again, I think the administration has a plan B. In terms of Congress, I personally believe that as we get closer to the U.S. midterm congressional elections, which will be held a year from November, Congress is going to become more active and maybe more critical of this tariff policy. And why do I say that? Because I think constituents now will be complaining as the tariffs are really taking a hold, whether it be prices going up, prices for the consumer, or prices for companies, or companies, small and medium-sized enterprises that have to go out of business because they can't afford to pay these tariffs or to even keep track of these tariffs. And so I do think that Congress will become more active. But again, I think we're in a really new world in the United States where clearly the executive branch is proceeding with a lot of passion and a lot of aggressiveness, and frankly, not getting a lot of questions as it kind of moves forward. But I just want to get back to the initial point I made, and that is that there is this growing feeling in the United States that the world order, the world trade order, as we knew it, based on the WTO, an order that allowed countries like Korea to flourish, over time have worked against U.S. interest. And the U.S. has kind of been paying the bill for other countries to flourish and compete against the United States on unfair terms. And, that's just it's not an isolated view in the United States. I think more and more that is kind of an accepted view. Where the differences lie is how do you address that through policies, and how do you treat other countries in order to try and adjust what we perceive as an unfair situation?
Thanks a lot. Penny, do you have anything to add for this longer-term perspectives on?
First, I want to completely agree with the last point Wendy made, that there is a general view in the U.S. that the U.S. has been victimized. And to be fair, this is not unique to the current administration. This has started much earlier, and therefore it's not going to go away. Also, I think there are going to be budgetary reasons that the tariffs are not going to go away. Perhaps the tariffs as practiced now, as announced now, are going to change. But the big, beautiful bill is going to is projecting a huge trade deficit, and whoever comes after the current administration will feel under pressure to keep the tariffs in place to maintain the revenue that comes from abroad. So I think the tariffs are not going to go away anytime soon. So we are at a turning point. And, in partial agreement with Bill, I would say that would be okay as long as we had some clear sense of where we are heading to. And that was the big advantage of the rules-based system, that no matter what the rules were, and some countries have argued that the rules were biased against them. They were biased against small developing countries. But no matter what the rules were, we knew them, and countries could figure out a way around them. The problem right now is we don't know the rules, even at the bilateral level. They are constantly renegotiated. And the uncertainty that this creates is going to have very important implications for the long run.
A quick one, really quick. I know we want some questions, but the deal, the rule is, right, you partner with the U.S., you get lower tariffs. You partner with the U.S., you invest in the U.S., you get benefits of low taxes. And the rule-based system that we're trying to get rid of is the one that allows China, the most advanced economy in the world outside of the U.S., to trade like an emerging market. Now tell me that that's fair.
Okay, well, thanks. We are, I think, getting some really important insight from our discussion. Even though there are many issues related to the current U.S. trade policies, there are strong background behind it, and a tariff that we are seeing probably not going to go away. It's not going to go back to the world trading system that we used to know. So what will happen? I guess we don't know yet. But I think Korea is part of the country that can potentially try to build a new system if it is possible. But anyway, let me actually ask a question, maybe given the time constraint, maybe one from the audience.
You said that the U.S. has many goals with this new rejigging of the world trade order. One is the deficit, trade deficit. And I'm an economist, and we have a little dirty secret called national income identity. And we see a great fiscal deficit as a result of this big, beautiful bill over the next several years. And I don't see the trade deficit going away despite all this tariff and negotiation. And what would they do? I mean, is Trump administration really serious about eliminating the trade deficit when the economics says otherwise? Some bandied about after the Liberation Day Declaration. Some people talked about Mar-a-Lago Accord, a product of Stephen Myron, who is the CA chair in White House. And would any exchange rate, rejigging would happen if this round of tariff negotiation doesn't work?
Can I give a one-sentence answer to that?
Yeah.
Which is, you're absolutely right. The only way to reduce the trade deficit and federal deficit is to get more savings, and that's what investment's all about. We can't raise domestic savings. We're going to get foreign savings. The tariff is a policy that switches where the deficits land, and we're trying to switch the deficit to our partners so that we import more from our partners. We try to put the burden of less of imports from those who choose to compete against us. So tariffs will switch expenditures with foreign savings to reduce the overall deficit.
Okay, just one response, and I think we should probably wrap up. Yeah.
I think that shows the absurdity of the current policy, because yes, in the U.S., investment is savings are too low to finance the investment. Domestic savings are too low. So what has been happening so far is the trade deficit closed this gap. So right now, we are trying to increase investment even more, but at the same time, close the trade deficit. These are contradictory. So this is the point I try to make. You can agree or disagree with goals, but when the goals contradict each other, then you have absolutely no idea where you are. And that's perhaps the worst part of the current environment.
Okay, so it looks like we really want to have more time to talk about this, but the time is up. So I hope that you kind of learned something from our conversation. And thanks for being here, and thanks for all the discussion. Thanks.